So good afternoon and welcome to our virtual class in your subject BAFM 6102, and this is financial management. This is our last topic in this course, and in this topic this afternoon, this is about mergers and acquisition divestitures. And I'm your professor from East Rizal branch. I'm Professor Susan Maminta. In our discussion today, our learning outcomes are understand the nature and kinds of mergers and acquisitions. Know the reasons why business combinations occur, understand merger valuation, understand and explain the different modes of payment in mergers and acquisition, understand the meaning of tender offer and how to resist it, and know the meaning and types of divestitures. There are issues on mergers and acquisition and divestitures, and these are part of the business news nowadays. These mergers, acquisition, and divestitures. And there are ways of restructuring companies in terms of their assets or even financial. And these are more competitive, not only in the domestic market, but also globally. So what is merger? Merger is a transaction involving the combination of two companies to form as one. So the acquired company existence ends and becomes a part of the acquiring company. So for example, company A and company B will join together and the acquiring company is company A. So the name will retain to company A on the name of the business. While acquisition is a firm buying another firm and no new company was formed. So just like company X plus company Y join together, and company X will be the surviving, and that is the name of the company now. So consolidation is a type of merger in which an entirely new firm was created. So that is also possible in a merger like company R and company S, and we'll have a new name like a company T. So take note that mergers and acquisition, despite their definitions, are often interchanged. There are kinds of mergers. One is horizontal merger. It is a combining two companies in the same industry. There are the usual competitors, and for this horizontal merger, they can achieve monopoly status and control the market. Like for example, the Facebook and Instagram, they join together as one company. Another kind of merger is the vertical merger. Under this is also called vertical integration. The two companies are in the same line of production, but the production stage is different, like a merger between the manufacturer and the supplier. So what are the reasons in their merger? One is to reduce fixed costs. Next is to eliminate other costs such as pricing, the contracting costs, and the collection of receivables. Or they can have a better plan for their inventory. Okay. A conglomerate merger is another kind of merger that is combining two companies who are in different line of businesses. To expand and stretch the risk, where the current business is not producing enough income. And that because of that conglomerate merger, that merger can create one big company. For example, when San Miguel Corporation bought these Philippine Airlines and Air Philippines. There are two types of conglomerate mergers. We have the pure conglomerate mergers that involve companies with nothing in common. Another kinds of conglomerate mergers is the mixed conglomerate mergers, where the firms that are eyeing for product extension or market extension. And for this, there is wider market or expanding range of products or services. What are the motives for these mergers and acquisitions? One is synergy, that under this, the value and performance of two firms, when combined, will be much greater than the sum of the separate individual companies. Number two is the growth, and that is the combination of expertise, assets, and market shares of the two companies that can lead to more optimistic opportunities in the market. Number three, acquiring distinctive capabilities. That means they help them acquire unique competencies or resources. The combination of resources and experiences can also lead to innovation and efficiency. Number four, cost reduction. Due to elimination or reduction of overlapping or unnecessary resources. Number five, possible response to government policies. There are some government policies that require a particular size of a company to operate. So that means the government that offer tax breaks and other incentives. Another motive is the lost cost of capital, the cost of issuing equities, and the debt becomes less risky and they can have a stable income. Another motive is the bankruptcy. And under this, that because of the merger, they can produce more wealth, they can lower the possibility of bankruptcy. And revenue augmentation, that means the revenue is being enriched and due to different credit and interest rate and liquidity risk. Now, merger can be valued by means of or with the use of net present value or DCF. Net present value method permits the acquirer and the target firm to calculate the forecast of the cash flow of the combined firm and discount to a present value based on its weighted average cost of capital, and that is WACC. Now, so the merger transactions can be paid in the following manner. One, that merger transaction can be paid through cash purchase or offering. So under this, of course, there is a cash involved. Or this can be paid, the merger can be paid by stock for stock purchase. That means the shareholders of the target firms are the initial price that they will be paid for their shares and the position of the acquirer. Or this can be paid in debt and preferred shares financing. That means the acquiring companies must also think that not all investors prefer increase in their shares. Others want to receive dividends or interest income. Other ones offering of convertible debentures and convertible preferred shares. So what is this convertible debentures? These are the type of long-term debt that can be converted into shares of equity stocks. And these convertible preferred shares are preferred shares that include an option for the holder to convert the shares into a fixed number of common shares. There are advantages of convertible securities. One is possible earnings dilution may partially decrease by the issuance of convertible securities. Another advantage is that it may permit the acquirer to conform to target firm or seller's revenue, and that is their objectives without altering its dividend policy. Another advantage is that the acquired firm may lessen its voting power by the issuance of convertible preferred shares. The convertible preferred stocks or debentures, that is also an advantage that might be attractive to the target firm because of its security protection combined with growth potential of ordinary equity shares. So another method of payment is the deferred payment plan. This is sometimes called earn out, and this is the latest approach to merger financing. The acquirer agreed to make a specific payment of cash or stocks, and it can boost its earning. It will make additional payment. So that is deferred payment as a method of payment in merger. Now, under this deferred payment scheme, it brings some benefits to the acquiring firm, like a rational way of adjusting the difference between that number of shares that the buyer or acquirer is willing to issue as well as the amount. Acquiring company will be able to report a higher equity per share because few shares will be outstanding at the time of merger. Number 3, the acquirer is given the downside protection for totally not paying the business to be acquired until the expected earnings have been realized. Now, let's talk about these hypothetical issues in deferred payment. That also must be understood that the acquirer's capability of an autonomous business operation to be able to identify the target firm shares to the total income. And there should be a freedom of operation in the management of the acquired firm's business by the acquiring company. The target firm's willingness to contribute to the growth of the acquiring company. So in payment also, we have this tender offer. It is an alternative approach in acquiring a company. So this interested company contacts the shareholders of the target firm and not its management, okay, to persuade them, the shareholders, to sell their shares at a premium. For example, the premium at the market price is $18.50, then this interested company or the acquiring company will offer to buy that stocks to the shareholders at the amount of 20 pesos, higher than the market price. So a tender offer may be done if the bilateral management negotiations will fail. Unexpected takeover of the interested acquiring firm may happen without communicating with management of the other company. But take note that this tender offer, or this what I have said, is considered an unfriendly way of merger and acquisition because you are disregarding the management. No? You're talking directly to the shareholders in order to acquire the shares. But there are ways to resist tender offers. So one is the white knight, that is called white knight. It is a firm that comes to the rescue of the target company for a takeover. And a Pac-Man, it is named after a video game. This trick is characterized by the situation that the target company becomes the acquirer. So, nagkaroon ng opposite situation. Okay, the target company is now the acquirer company or the acquiring company. Well, a golden parachute way is a kind of approach that the acquirer must compensate the management of the target firm, and that is paying a huge amount of money for an easy access to the new companies. The poison pill, this involves an automatic actions to be done if an interested party attempts to purchase the firms. Another is this shark repellence. It is an attempt to discourage tender offeror. A target firm may, for instance, to do something like effecting changes in its bylaws regarding the term of office of the directors. So this will delay the purchase of majority of the existing board. We also have this green mail, that is a defensive method applied to save the target firm against takeover after the bidder or acquiring firm purchase a big number of shares in the open market and then attempts to make a tender offer. The management of the target company who are opposed to the takeover may offer the acquirer a self-back of his acquired shares at price above the market value. So this is a kind of buying back the shares of the stocks. Another is the flip over rights. Okay. This bigger interest in acquiring company in exchange for their equity share. We have also this issuing equity rights, and this is the kind that a target firm effect a significant increase in the amount of outstanding equity share. While a reverse tender is a kind of a tender offer of the target corporation that is made to effect control of the acquiring company. And the crown jewel transfer is the assets that make the target firm a desirable target that is sold or disposed by the target corporation. A legal action, that means one or more of the features of a tender offer, may be questioned by the target corporation in court. Number 12 is this is a fair price provisions. Under this, shareholders of the target firm may be issued warrants to permit purchase of equity shares at a small percentage of the current market price in case of takeovers. So now let's talk about these divestitures. A divestiture is a way for a company to manage its portfolio of assets. As companies grow, they may find that they are trying to focus on too many lines of business and close some operational units to focus on more profitable lines. So that is divestitures, looking for the most profitable and close the other operation units. And that is a way of managing the portfolio assets. There are types of divestitures. We have the sell-off and the spin-off. In sell-off, the selling of a subsidiary or a product line or a division by a company to another company. So that is not the whole company that is being offered, but only a portion of that company, a part of that company. It can be the subsidiary of the company, it can be the product line, or it can be one division only. So under this number 2, that is spin-off types of divestitures, it has the separation or separating the subsidiary from its parent company. That means without changing the equity ownership, only the subsidiary will be taken out from the parent company. So the new shares for the ownership in the divested assets are issued to the original shareholders on a pro rata basis. Another types of divestitures, we have this liquidation. And under this, that's shutting down or dumping of an asset. So in this case, the assets are sold to another firm and the proceeds are distributed to the shareholders. Going private, this results when a publicly traded company is purchased by a small group of investors and its shares is no longer sold on public exchange. And that is the reason it's going private. And leverage buyout means there is a unique way of going private, but the incumbent shareholders sell their share to a small group of investors who paid them using their unused debt capacity in order to borrow money. Okay, so that is those are the type of divestitures, and this is the last topic that we have in this merger, acquisition, and divestitures. So I'm now giving you my last slides. Again, class, thank you for listening.